Welcome back to the Property Trio podcast, the podcast for the sophisticated property buyer. I'm Dave Johnston from Property Planning Australia, and I'm joined as always by buyer's advocate Cate and the depreciation expert himself and data wrangler Mike Mortlock. Today,
just pumping myself up a bit.
I want a more exciting title from ChatGPT next time you push that button.
That is good. Today we're unpacking a question that's been bubbling up in headlines, boardrooms and barbecues apparently. Is the Australian property cycle broken? For decades we've relied on the idea that property moves through a predictable rhythm, boom, peak, decline, recovery, and that if you bought and held for long enough you could count on your asset doubling every 7 to 10 years, in theory. But lately, that playbook hasn't always held up so neatly. And so we thought we'd unpack that a bit for you today. So is the cycle still a useful framework, or this particular cycle that I just described that people have referred to often, or is it time to rethink? So we're going to break this up into 3 segments. This is segment 1. What is the property cycle and is it still useful? Cate, let's start with the basics. When you talk to clients, how do you usually explain the property cycle, and do you think it still holds water?
Wow, big question. I don't think it still holds water. And if we look at the last 5 years, who could have predicted any of that? Sometimes unforeseen things happen and they really shake up markets. But traditionally, we've described the property market as moving through 4 phases: boom, downturn, stabilisation, and recovery. In concept, it's very neat and tidy. It's been useful for helping clients understand that price growth doesn't happen in a straight line. But lately, I'd say it's far less than tidy. You've got suburbs moving in different directions at the same time, market segmentation, local supply and demand dynamics playing a much bigger role than the national economy. So the cycle concept still has value, but you've got to be prepared to look locally and be far more granular when you're taking into account the things that will make certain market segments fluctuate.
Yeah, and I'm sure we'd both argue, and we've talked to our clients for a long time, that has always been the case, that you've just outlined. And, you know, that boom, downturn, stabilisation, recovery is a simple way to sort of, you know, as you said in the part of the intro, for people to sort of conceptualize what can happen in a marketplace, but you need to dig into the detail because you know, things aren't homogenous.
Not at all. It's, you know, we can't just look at that property clock and go, all right, here's Melbourne's property clock. I think those days are past us. And in our most recent market update, we certainly talked about some of this. In fact, Mike, you cited Terry Ryder saying that some of these capital cities that had had a really good rate of performance for having a second win. I mean, that's not in line with the property clock cycle, is it?
No, and I think, and again, I think that's always been the case. So, Mike, how does that sit with the data? Are we seeing a clear repeating cycle in national or state level housing figures anymore, or have we ever?
Well, I think I'd love to answer this without going on a tangent, but I'd love you to indulge me, dear listeners.
No, we do tangents.
Hosts. I think I want to try and weave in evolutionary biology. I think there has been a value in identifying patterns for animals and humans for millennia, right? You talk to someone that looks after a crocodile in a pen and they say, this thing watches me, and if I do something different, like it'll watch me do something 100 times, and if I put my foot in a slightly different position, that's when it gets me. And I think if you think about human evolution, you know, observing the movements of the stars, how the sun rises, where the animals go to drink in the morning, you know, like understanding those patterns has helped to keep us alive. So I think it's a human thing to chuck observations that fit a pattern because it fits in a really nice box in our head. I think, you know, the cycle itself, you know, the upswing, you know, the downturn, the recovery, those are very observable things. But I think when we're trying to say, look, property doubles in this time frame, that's where we are trying to force a human construct onto data that behaves in a bit of a different way. How do you rate that tangent? Am I allowed to go on any further ones, or is that
I think it's great.
final
You know,
note?
No, I
it's
think
full of 72. I love it.
yeah, I think that's great, and I think we all agree, to be honest, with what you've just described. Patterns are really useful because it helps sum up a broader, bigger picture of things, but when you break them down into individual aspects, they don't always behave the same way. So, it's a great segue into the next segment, because the metrics some property people have traditionally relied on seem to be shifting. And let's get into what's actually changed. So, this is segment 2, what's changed and why it matters. So let's look at the economic levers. Mike, we've had a record-setting interest rate cycle where the RBA rose rates at
Quite
the
aggressively.
fastest, quite aggressively, fastest rate on record after reducing rates to the lowest on record following the once in 100 years pandemic. So, in other words, it was all due to a very unique event. So what's happened? Let's remind our listeners, how has the market responded while those hikes were actually happening?
Yeah, well, the RBA really made history. Between May 2022, November 23, we went from 0.1% to 4.35, so 425 basis points in 13 moves. It's the fastest and steepest tightening cycle in Australian history. So traditional logic would dictate that that should have triggered a sharp correction in house prices. Borrowing capacity was slashed, sentiment was shaky. Of course, there was a pandemic, but core logic showed that, of course, there was a little bit of an initial dip as we all got our perishables, stocked in our pantries. Prices bottomed out in early 2023 and began climbing again, even while those rates were still rising. By the time the RBA paused in November, national dwelling values had recovered most of their losses, with places like Perth and Adelaide hitting fresh record highs mid-tightening. And that doesn't sit in the textbooks from my view. There would be a lot of people saying, okay, with a thought experiment, if interest rates rise that quick, all house prices have to suffer. And I mean, the big banks were talking about 15% crash in the property market. And I mean, 15% would be a type of crash, right? Like the downturns never really go above 8%.
Yeah, look,
Yes.
that's right, Mike. And yet, for our clued-in listeners who have gone back and listened to our back catalogue, they would know that in episode 158, we walked them through the history of property price movements when rates go up. And it showed us that generally prices still keep on rising. So even though that's sort of counter to the common expectation or perception of what happens, history tells us, and we'd told any of our listeners who spent the time to go through our entire back catalogue, that that's not what happens. So, Cate, what were you seeing in the market in Melbourne as those rate rises were unfolding?
Yeah, this is a perfect example of how states can vary, because what I was experiencing at my coalface was very different to what some of those other capital cities and states were experiencing. It was fascinating, actually, Dave. We saw a brief pause in buyer momentum, especially after the first few hikes, but it didn't last long. By late 2022, many buyers had recalibrated and accepted this kind of new norm and re-entered the market with revised budgets. Fair to say, though, that Melbourne was a bit of an anomaly state, was an anomaly city for a while there. In fact, Victoria was plagued with other legislative changes and tax regimes that slowed us down in contrast. On the vendor side, though, listings remained extremely tight. You'd expect that rising mortgage rates and I guess anything fueling mortgage stress would see a rush of stock onto the market, as people are freaking out or finding it really hard to cope with their own personal cash flows. But that hasn't happened, and certainly not the magnitude that was predicted. So while it's true that most ultra-low fixed loans from 2020 to 2021 have now rolled off, borrowers are still holding back from selling for various reasons, likely hoping that rates will ease before they make a move. And, possibly they were forced to make some of those big decisions, especially in Melbourne during COVID and lockdown, and they're just wanting to sit tight and recalibrate where they're at. So I guess in essence, we're seeing more people choosing to tighten the belt than to sell, and that's keeping supply tight even as financial pressures increase.
Yeah, so even with repayments increasing significantly for many property owners and investors, and even doubling in many cases, people they want to do anything they can to hold on to their property, particularly homes, and we saw that play out. So we didn't see a huge amount of supply come onto the market. We didn't see that much distress selling. So according to the often quoted doubling in all property doubles in 7 years line that people trying to sell property or the idea of property investing tend to spruik, that doesn't necessarily happen like some of those spruikers will tell people and told people for a long period of time. Mike, what are your thoughts on this?
Oh, look, I guess I think it's bullshit. Just put my own little beep in there. Hopefully I timed it well.
I could still hear you say bullshit though, Mike.
Oh, damn it. Anyway, we'll fix that in post or leave it in because we're having fun today. Yeah. Look, I think it is rubbish, and it's interesting that you highlight, property educators. I think I've been to a bunch of seminars, like maybe 10 years ago.
I didn't say the word educators, though. I said spruikers.
Spruikers, yeah. Well, I'm using their term. They call themselves educators, but yeah. I'm sure I would have seen. It's the new property type people just throwing that out there, like, it'll be fine. Property doubles every 7 to 10 years, so don't worry about the negative cash flow of having to maintain it, because it's almost like a guarantee. And I think it's rubbish. And when it comes to some of the points that Cate was making about, we maybe predicted people to be selling, I think you mentioned it in the May market update, that the household savings ratio went through the roof. So we actually did have some buffers in place. There wasn't that much duress from a global pandemic compared to what it could have been. But the reason I suppose I wanted to do this episode is because maybe a year or two, CoreLogic did share data on how long it takes for cities to grow around the country. It got a lot of media at the time, but we haven't sort of talked about it for quite some time. And I just thought we would raise this. Is this something that we can sort of fully put to bed? Their data showed that Melbourne took 13.1 years, Sydney 15.4, Brisbane 17.2, Perth 17.8, Adelaide 16.6, Canberra 15.6, and Hobart was the clear winner at 8 to 9 years, but obviously an exception. So you average that out, it's closer to 15 rather than 7 to 10, and 15 is more than double 7 for anyone that's a maths wizard playing at home. And if you look at it nationally, with an average annual growth rate of 5.4, the rule of 72 puts the doubling point at about 13.3 years, and that's in stable conditions. But I mean, I wouldn't even want people to start saying, oh, property doubles every 13.3 years, because that will turn out to be not true as well. There is no sort of formula that you can shove it in, although in segment 3, Dave, a lot of people have tried, and there's another thing that we need to talk about, but I'll leave that to you.
Yeah, so it sounds like a good time for us to jump into segment 3, the 18.6-year property cycle, myth or market map.
Have you guys heard much about that 18.6 cycle? I mean, it's something that lots of people are really huge devotees of. Yeah. I've spoken to some economists who are big believers in it, maybe because it's the body of the work of the economist rather than this particular theory. I'm not sure. But there's some real diehard fans of this idea.
Yeah, look, I mean, I'm somewhat skeptical, I must say, when... firstly, I've referenced that point a number of times over the journey, that the actual rate of growth, according to CoreLogic, has been closer to 5% for some time. That's why we model out 5% growth in our property plans and have for a long time to be realistic and even conservative. And, another conversation that needs to be had at some point in time is what is the impact of renovations on all the established properties having on the growth in property values? And sure you have, and this is going off a bit of a tangent, but sure you have a depreciation going on the dwelling on all properties, but offsetting that to some degree is all the renovations and knockdown and rebuilds that feeds into new property sale prices and therefore growth. So the point here is that tracking the growth in property isn't like we are tracking a static market. And this is often not considered, but it reinforces why understanding property prices is very nuanced. And, Mike, we've discussed the traditional property cycle and its apparent shifts. But as you've just shared, there's this other theory that keeps popping up in some corners of the investment, or maybe the economic world, of this 18.6-year property cycle. Stating one number like this on a hugely wide and dynamic marketplace invokes for me the image of, eager kids in a classroom raising their hands at the teacher wanting to be picked and say, look, teacher, I've solved it. I know the answer. Look at me. But they've come up with this number, 18.6. So, what are your thoughts here?
I could tell you why this one has more legs than the other, because the other one said 7 to 10. This one says 18.6. And anytime you get that specific, people are like, well, that must be true. So it's winning on that metric. But it is a pretty fascinating one, and it has a bit of a long history and legacy. The idea is that markets tend to follow a near 2-decade rhythm of boom, bust, and recovery. And as you mentioned, popularised by economists like Fred Harrison in the UK, and Phil Anderson has modelled it here in Australia. They looked at property patterns going back hundreds of years, and I think specifically they're looking more at land values. They claim the cycle plays out with surprising consistency in the US, UK, and to some extent in Australia.
Yeah, look, I mean, it's pretty interesting to say that the property market, despite all the changes in the world over those hundreds of years and across various countries or continents, follows a consistent cycle. But maybe I'm oversimplifying things here. Cate, what do you make of this? Does it line up with what you've seen over your last 18.6 years in the market?
Well, I think the first thing we need to circle in on is the integrity of our data and the availability of it. And I challenge anyone to get us some great data pre-1970 for Australia.
Good point.
Because we just didn't collate it like we do now. So we can look at our own runway and determine whether we think that there's, some data points or some evidence of a cycle. I'm pretty dubious as well. What I won't talk about is international markets, residential markets, because I haven't studied them and I'm not familiar with them. And it might well be the case in other nations. But if we're really wanting to try and, identify some data points and draw a bit of a story, there are patterns that resemble that cycle. If you trace back to the early 1990s recession, then look at the early 2000s recovery, the GFC correction, the post-2012 boom. I mean, you could roughly make up an 18-year rhythm there, but I think I'm really clutching at straws. And I'd remind anyone, we've got to be careful. These patterns are influenced by so many other factors, fiscal policy, immigration, planning laws, interest rates, pandemics, state government, federal government initiatives, incentives. It's, I think personally, I'm not someone who subscribes to the 18.6 growth cycle rule of thumb in Australia.
Yeah, and look, I think, some cycles 22 years and then some 11 and some 19 and some 13 and voila.
Oh, have a look at the last 5 years.
18.6 over hundreds of years. In that example, that's 18.75. But
Yes.
yeah, so do those cycles themselves then change, which sort of goes back to that same point of don't expect it to be 10 years or don't expect it to be 7 years. But look, I do think it's interesting, these 5 key phases that they suggest occurs, Mike. That I find that probably more interesting. What are the key phases of this 18.6-year cycle according to these two guys?
Yeah, I agree. And the summary of this episode is that it's all I'm not going to hit my button again. It's all rubbish. But I mean, it is interesting to observe these phenomenons and these things that become barbecue conversation like its actual lore, LORE. The first phase is recovery. So 1 to 7 years, property values stabilize and grow slowly after the preceding downturn. The second phase is the mid-cycle slowdown. So after years 7 or 9, we have a temporary cooling, which is often triggered by policy or sentiment. And this is where it's so interesting to say that, you know, there is this predictable thing over hundreds of years that says between years 7 and 9, we often see a policy or a sentiment shift. The third one is the boom years. So between 9 and 14, strong growth, investor activity, rising land values, of course. Then we move into the winner's curse, years 14 to 18, and that's the euphoria and the overexuberance and speculative behavior going through the roof. And, you know, we can observe some speculative behavior in markets that we have right now. Then the last one is the correction or the recession, 18 to 18.6 years, which is good. It only lasts 6 months.
Very short.
It's a reset period before the cycle restarts. So if we look at the last major correction point for the GFC around 2008, 2009, then according to this model, we're entering that peak phase territory now. But I think, like the segue on behavior, but, you know, evolutionary biology, this is a human being trying to shove a pattern on a data source.
So which stage are we entering now? Number 4, winner's curse, or 3, boom, or in their theory?
Yeah, that would be the peak phase. So the boom years, strong growth, lots of investor activity.
I like how they've just assigned the correction or the recession to a mere 6 or 7 months, and I think we all know that downturns can last for far longer than that. They might not be super aggressive, but they generally span for longer than that.
Well, we know Perth and Darwin have just ran for over a decade with a flat or correction period.
That's right. If we think about, you know, that 2017, 2018, all the way to the federal election, you know, that was a shortish downturn by historical standards, but it was still greater than 6 or 7 months.
I think we can probably put these theories about, you know, being able to pin a market cycle to a time frame, you know, in the same sort of bucket as the mean reversion theory. You can kind of you can transpose it on top of something and have it line up and have it make sense, and you could make it look, you know, like a brilliant kind of Nostradamus-like prediction, but it's just not a uniform thing that always works, in my view. But I'd be quite interested if there are any listeners that are real devotees of this 18.6 year cycle and see whether they believe we're missing anything. But for me, it's just I can't find a way to make it work.
I would be very nervous about endorsing someone relying on this cycle to time the market. And we've talked about timing the market before anyway. You know, property investing by nature isn't suited to trading. It really is suited to a long-term play because of the entry and exit costs associated with it. But I certainly wouldn't be printing up this cycle and relying on it for market timing purposes, that's for sure.
Yeah, look, I think it's looked at nations by the looks of it, and we know in Australia itself, our capital cities have moved at different time frames. You've just actually pointed that out as part of this episode, how each of the capital cities moved up over a decade, doubled in price over a different period of time, Mike. So, you know, it's like, well, the property market isn't all of Australia. It's not one property. So you've still got to boil it down to, you know, what's your strategy? What market are you going to try and enter? You know, what type of property, what micro location or suburb within that regional centre or city you're going to target? And it's probably going to be at a different stage of a cycle, potentially and likely, to other capital cities or regional centres. So, you know, it just isn't. The market cycle isn't some kind of homogenous behaving thing. And find it. So you're not going to just be able to overlay. I wouldn't have thought 18.6 years and these timeframes on the cycles across every city or regional centre. I mean, as I said, I do find the idea of these 5 cycles or stages interesting and worth a deeper dive, maybe in another episode. But trying to sort of overlay that onto every market, I think, is pretty high risk. But Mike, what are your final thoughts?
I think the marketplace is very different to what it was maybe even as recent as 10 years ago. I mean, the participation rate for property investors, like if you go back to 2021, we had roughly 2.25 million Australians owning a property. In the 14-15 financial year, it's 2.05 million. And I can remember going back and doing research projects where it was 1.4 million. So, in 5 years, we're seeing a 12% growth or thereabouts. And I think if you go back maybe 30 years, price movements were driven by the local economy, much less by nationally focused investors piling into an area because they see potential upside. So we used to, I think, be able to talk about almost the property market from a national perspective, but I think those days are absolutely over. So when we're trying to say 18.6, we've then got to try and not only extrapolate it to Australia, but we've got to go, okay, well, where is Perth in the 18.6 compared to, let's say, Hobart? So it's getting harder to rely on a model. I think it's a useful lens to throw over the property market and pair it with other data, and it's a good thought experiment to try and understand some movements. And obviously, we'd all love to have the magic sauce and be able to predict things, but with the explosion of AI, there's a lot of interest in the property market, and nobody has yet to come up with the algorithm that can predict exactly what's going to happen. I think what matters more than the actual time frame, whether it be 13 years or 5.3%, is more about understanding what phase your market is. I think those market phases as part of the 18.6 year pattern are interesting and worth considering. But really, making financial decisions based on data analysis over a long time frame that's internationally focused, that is talking about hundreds of years, I just don't see a time where that's going to be a sensible strategy.
Yeah, well said, Mike. Well, let's wrap it up there and come back shortly with some gold nuggets.
Now it's time for us to go mining for our gold nugget property tip of the day.
My gold nugget is about the rule of 72. It is a really handy little rule to use, but quite often we've heard, as we've said in today's ep, property markets doubling every 7 years, which would suggest that you're getting, better than 10% per annum performance on your capital growth, and that isn't a realistic expectation to aim for. You're most likely going to be very disappointed if you're looking at getting that kind of performance year on year over the long term. So taking a leaf out of Dave's book and working on more conservative estimates will only give you a bit of a nice surprise if your property does exceed those expectations.
Well, I mentioned in our market update recently that I was talking to the professor, and we were having a bit of a chat, which I really enjoyed. He brought through some old property investing tenants, and the challenge was, has anything changed? Has traditional logic from 10 or 20 years ago, or not to be unkind to Pete, he's maybe been in the game even longer than that. And, things like it's time in the market rather than timing the market. That particular one, I thought that's the one that I could probably go after the most, because I think as Australians, we're far more interested in timing the market, at least on the front end, and then we'll stick around. But we want to get that upswing. But the rest of it is just, things like the availability of credit, like the local economy and jobs creation, things that are unique or have a scarcity value, like character homes with a water view, with close proximity to lifestyle factors. I mean, these are the kind of things that I feel like you can set your watch to, rather than 7 to 10 years or 13 years or 18.6 years. Those kind of tenants, I think, are worthwhile being subscribers to. But this sort of stuff, I think you can just kind of get lost. And Dave, I'm sure in your business you come across a lot of people with, analysis paralysis. This is just another rabbit hole that they can go down on. And what is probably more important is picking a strategy and being decisive and making a decision. Because if you're spending 12 months, to research before you're jumping into markets at the moment, some of these markets are doing double-digit growth in that time, and that can actually be even more costly.
100%, and get that decision at least 60% right. Get it 70% right, make a decision, and be in the game. And you're likely to win over the long run and be able to build on top of that initial decision with a second decision and a third decision, etc. I mean, my gold nugget is, look, when I hear of the answer is this number, whether it's 18.6 or whatever, it does remind me of The Hitchhiker's Guide to the Galaxy, which was a book and TV series that was huge when I was a kid. Some of our listeners may have never heard of it, but there was this group of super intelligent, multi-dimensional beings who built a supercomputer named Deep Thought to calculate the answer to the ultimate question of life, the universe, and everything. And after 7.5 million years of computation, Deep Thought finally revealed the answer. It was 42, which meant absolutely nothing. And so my gold nugget is, when someone you're working with or is trying to sell you an idea tells you some sort of answer that's really simple, like property prices double every 7 years, or you'll get 10% capital growth over the next decade, or these types of things, I just say be very wary, take it with a grain of salt, because if life was that simple, then everyone would be doing it.
That's
well said.
Well
42.
said indeed. 42. I love Douglas Adams. That's a cracker.
Well, on that note, I think that's been a really enjoyable episode. Love the 3 segments as we sort of transferred through those different ideas. And thanks very much for putting that together, Mike. And
I think we broke it. We broke the property cycle's broken.
I just hope the 2 professors or economists who put that information together don't listen to this episode. They won't be too happy, probably. On that note, we'll see you next week.
See you guys next week.